Welcome to the second part of the first session on financial intermediation banking of the We Are In conference, the fifth edition of the ECB. We have two more papers in the session. The first one will be presented by Elena Carletti, professor at Bocconi University, and their paper on climate and climate lending and common ownership will be discussed by Eleonora Sfrappini, professor at the University of St. Andrews. Elena, the floor is yours, and you have 25 minutes.
Thank you. Good morning to you all, and thank you very much for the invitation to this conference. This is somehow, for all of us, I guess, an unusual setting in that we are not used to have such a female audience in front of us, so I think this is really unique and very special. And it is so unique and very special that when Agnese asked me to present something in this conference, I thought that this would be a more informal gathering to get advice and suggestions and feedback on work in progress. So what you're going to see today is not something that is so formal and final as the nice paper by Manju, but it's something really work in progress. So it's more the direction of travel that you have to get, more than the individual and the specific result. And I want to apologize with Eleonora because she did not see any paper, and she just received a set of slides and even changed yesterday at midnight. So this is where we are with this. So having said that, let me tell you what is it that we are trying to do. And again, the main objective for us is to get feedback, in particular, on how to bring this travel further. So we all know that there is a high exposure of banks to fossil fuel firms. But maybe we don't know that if we take the 65 bigger banks in the world, they have committed to almost $8 trillion of financing to fossil fuel industry since the Paris Agreement. Now, we can say whether this number is big or small, but it sounds a lot still, given that we wanted to go towards a situation where there would not be much financing to fossil fuel industry. And we know that this has implications for financial stability. But apart from this lending exposure, we don't really know whether there are other ties between the fossil fuel industry or the brown industries more generally and the financial sector. So this is precisely what we want to do in this paper. We want to look at whether there is another type of tie, which is common ownership. So to which extent have fossil fuel firms and banks similar or the same shareholders? And to which extent is this an important phenomenon for lending conditions? In particular, we want to look at two main questions. First, how does common ownership between banks and fossil fuel firms has evolved over time? And in particular, how it has evolved as a response to climate policies. So take the Paris Agreement, for example. Have we seen that the Paris Agreement has reduced these ties between fossil fuel industry and banks? Or on the other hand, instead it has had the opposite result of increasing these ties? And we are going to use two measures of climate policies. One is the Paris Agreement, and the other one is the level of environmental policy index, which you may know is an index in the United States. It looks at the most important US newspaper, look at 80,000 news, and basically calculate an index that is this measure of stringency of climate risk, of climate policies, so of fight against climate risk, if you want. And then we want to see, okay, once we establish this common ownership between banks and fossil fuel, and we compare this to common ownership between banks and other industries, does this affect the lending? And in particular, does this affect pricing? And we are going to look at syndicated lending. So what are the main results in brief? So as we would expect somehow, and as would be desired, common ownership between banks and fossil fuel is typically lower than common ownership between banks and other firms, as these climate risk policy measures become more stringent. However, we need to distinguish between intensive and extensive margin, in that what we find that for the situation where there was already common ownership between banks and fossil fuel firms, this common ownership does not decrease or even increase after the Paris Agreement or when this index becomes more stringent. And instead, what we find is that on the extensive margin, instead, there is less likelihood. So basically, if in a pair of fossil fuel firm and the bank, there was already a common shareholders, then this relationship may increase after the Paris Agreement and when this index becomes more stringent. Instead, if there wasn't any tie in terms of common shareholding, then this tie is less likely to appear. So there is a big difference between intensive and extensive margin. And how does this affect the prices of syndicated loans? Well, loan prices are lower when there is more common ownership between banks and firms. And loan prices for fossil fuel firms tend to be higher than for other firms. But again, after Paris Agreement, these prices are lower. So again, we get a different result, an opposite result from what we would have liked to see. That is, if there is Paris Agreement, it should be more difficult, that is more costly for fossil fuel firms to get funding, and instead we get the opposite result. So this is where we currently are. As I said, it's very preliminary. We don't claim any causality whatsoever, but we thought that at least already describing this phenomena of common ownership is in itself interesting and important. So let me skip the contribution to the literature for sake of time, and let me tell you instead more about the methodology. So I do refer to common ownership, but what do we really mean for that? So the first one is simply the number of overlapping investors. If you take firms and banks, how many overlapping investors they have, and again, we look at firms and banks, and fossil fuel firms and banks. The second one is the common ownership shares held by overlapping investors, and with a look at the shares in banks and the share in firms. So let me be more specific. So what do you see here? Do we have a pointer? Yeah. So take the first part here. So you have a firm that can be a normal firm or a fossil fuel firm, and then you have a bank, and you have investors. So what do you see in this case? Investor one will have a 5.58% in firm A in terms of shares, and 4.96 in the bank B. So this will be a common shareholder, and this will be, if you do the same with the other investor, this will be the sum of the common ownership in the firm share, so how many shares common shareholders have in the firms. And the same we can do for banks. This investor will have a 49.6, 73.13, 404. If you sum them, this will be the sum of the shares that common shareholders have in banks. And we can do the same before Paris and after Paris, or, as I said, depending on the level of this policy index. So you see here, for example, in this particular example, which is taken from actual data, you see that the common ownership shares in firms, which is the sum of these three numbers and these three numbers, before Paris is 16.18, and after Paris, this is 17.15. You can do the same for banks. This is the sum of the common shares in banks before Paris, the sum of common shares in banks after Paris. You see this is increased. And in terms of overlapping investors, in this particular case, it's the same, but we could have a new investor that has come in after Paris. So this would be the intensive margin, if you want, the change in intensive margin. If we had a new investor coming in, this would be more the extensive margin, okay? So this is how we do. And we follow the literature in there, but what we would like to see is a little bit a more synthetic measure that can measure more the strength on both sides. But this is what the literature does so far, and this is what we follow for the moment. Which data do we use? Well, we have the universe of US publicly listed firms from a Refinitiv icon. We have sector disaggregation based on climate policy relevant sectors. And we have, we just take the firms that belong to sector one, which are really the brown firms, the fossil fuel, and then we take the greenest. So the treated group will be the fossil fuel, group one. The controls will be the greenest firms, that is the sector 9, so those that are farthest away from being classified as high climate risk firms. And then we take the 71 largest publicly listed banks, and that are not necessarily in the US, but of course we match them with the US firms, so you should think of these banks as being based in the US, basically, or being active in the US as well. So what is the time frame? We take, for the moment, 2001-2024. We have quarterly information about equity shareholders from Thomson Reuters Global Ownership Database. We use mostly 13F. Then we take all the investors that have at least 1% in either the firm and in the bank. So this is the level of common ownership. We tried with different level of threshold. The literature usually uses 1%, 3%, 5%. We tried also with asymmetric, if you want, shares, meaning maybe 1% in banks, because typically there is more concentration in the bank ownership than in the firm ownership. The results are more or less the same. So in this particular version, we went for 1% on both sides. And then we use syndicated loans data from Discussant, and then we have control variable from Refinitiv icon. So here you can see a little bit the summer statistic, but what is important is that, of course, so these are the common ownership from the firm's perspective in bank and the number of overlapping investors. You can see that here we only look at the Paris Agreement. You can see that there is an increase already in the descriptive statistics, both of the shares in firms and the shares in banks. But basically, and the same for the number of overlapping investors, although in this case you see that the increase is not that much, which again suggests that if there is an increase in common ownership, in particular for the fossil fuel industry, that is more on the intensive margin again, rather than new investors coming in. And if you think, now put yourself in a bank perspective, it's much more difficult for a bank to go up there and say, we start after Paris to finance, we start to have common owners and therefore finance more fossil fuel. It's much easier that if you are already in the business, maybe shareholders try to get more ties, and for the banks it's easier if it is already in the business of lending to fossil fuel. But this is at least what the data tell us so far. Let me move on before Agnese tells me that I'm late. So we start with very simple OS regressions, extremely easy. So what we have, we do an OS estimation in each quarter where we estimate the common ownership, again, from the firm, the bank, and the number of investors. We look at all three measures, and we regress on a dummy of fossil fuel that is equal to 1 when in the pair of bank and firm, the firm is fossil fuel. And then we interact with this, we have the policy measure, and then we interact, and these are the two coefficients we are most interested in. We interact with the measure of the climate risk policy measure. And as I was saying before, we are going to use two different types of measure. One is the Paris Agreement, simply before and after the Paris Agreement. And the other one, we are using this Environmental Policy Index, which is taken from this paper of Noelle et al. And this is an index based on news of US environmental and climate policy on the most important US newspaper, and it's about 80,000, as I was saying, news that they are scrutinized, and then with algorithm, they try to use these news to measure the stringency of policy. And then we have a bunch of a firm and a bank control and a number of fixed effects. So what do we find? So we find, just focus on this, we find that in general, the common ownership between banks and fossil fuel firm is lower than the common ownership between banks and other industries. That is across all specifications of our measures of common ownership. So in general, there are fewer ties in terms of common shareholdings between banks and fossil fuel firms. But you see that this is after Paris only, and after Paris, we see that this becomes even lower. So this is what I was telling you before. This is what we would have expected, that if there is more stringency in terms of climate policy, we would expect that this tie, assuming that this tie has an impact then on lending, becomes less important, that is weakened. And this is what it tells you. And the same goes from this environmental policy index. The result is, again, that the fossil fuel is negative, so there is lower common ownership between banks and fossil fuel firms rather than other. And this becomes even smaller when there is a stringency, when the level of this index indicates that there is more stringent policies against climate in the country. However, we want to disentangle, as I was saying, intensive and extensive margin. So what does it mean? Well, it's normal. When you have extensive margin, so you had take two pairs, there was no common ownership of any type before, and now it starts to be a tie, so the new investor comes in and starts acquiring shares in this pair. And instead, on the intensive margin, is clearly the change relative to before and after. And if we do that, what do we find? This is for the intensive margin. What we find is that still you have a growth rate of common ownership in general that is lower for fossil fuel firms and banks, and this is true across all measures that we can look of common ownership. But this time, after the Paris Agreement, you see that there is a reverse. So after the Paris Agreement, the growth rate of common ownership becomes more similar between fossil banks and fossil fuel than that to other pairs of banks and firms. So in other words, the Paris Agreement that should have led to a weakening of the common shareholdings is actually leading to the opposite result for what concerns intensive margin. We can do the same, and the same holds for the environmental policy index. We can do the same, and more or less the results are the same. If you have more stringent policy index, meaning that the policymaker try to fight somehow climate risk even more, you see that the negative coefficient of the fossil fuel here becomes weaker, so that there is instead a reverse of the initial result. Now, on the extensive margin, however, you see that that's not the case. This is what I was telling you before. So on the extensive margin, we can do the same things, and you can see that the common ownership between banks and fossil fuel is less likely to materialize than common ownership between banks and other firms, and is even more so after the Paris Agreement. So overall, we have lower common ownership between banks and fossil fuel than between banks and other firms. But that is even more true after Paris, but this result is driven by extensive margin, because on the intensive margin, we see rather an opposite result. Okay, so, but now, what do we do with that? So now, can we say, assuming that we have this intensive margin that may be driving something, how do we look at whether there is indeed an effect of this stronger common ownership between banks and fossil fuel firms on loan pricing? And this is why it's even more preliminary, this part of the analysis, but let me tell you where we are currently. So what we do, we regress, we take now loan syndicates, so we only look, of course now the sample is completely different, we only look at the firms and the banks, both fossil fuel and others, that are within the syndicate data set, the syndicated loan data set. And what we have is that we regress the loan price, and this is a spread over the LIBOR, on a number of variables, as you see here. So we have common ownership. What is gone? Common ownership. Then we have our fossil fuel firm dummy again. We have our measure of climate risk measure. Then now we only, for the moment, we only focus on Paris, but we are doing also the result for the environmental policy index. And then we have a number of interactions. What we are really interested in is to see whether common ownership has by itself an impact on loan pricing, and whether in particular one would do the triple interaction with fossil fuel firm and the before and after Paris, whether this has an impact as well. So that's what we are doing, and again, we have a bunch of controls and a bunch of fixed effect. So what do we find? We find that here, again, look at this one. So irrespective of how we measure common ownership, we have that the common ownership, on average, tend to reduce loan pricing. So that indicates that common ownership, so why do we have this phenomenon of common ownership? So having common ownership between banks and firms indeed change the loan pricing condition. I think that is already something that is interesting, again, in itself, that common ownership has an impact on loan pricing. And in general, we see that for fossil fuel, you see that prices tend to be higher. But after Paris, they try to be lower again. So again, fossil fuel prices tend to be higher than, prices of loans to fossil fuel companies are typically higher than prices of loans to non-fossil fuel companies. But after Paris, we see a reverse. So after Paris, there are lower prices than before to fossil fuel firms. And that is something that, again, we shouldn't have expected. I mean, somehow the risk of these companies, ceteris paribus, even only for the policy measures that have been taken, should have gone up, and banks should have priced these loans accordingly, possibly. And instead, through the measure of through the mechanism of common ownership, we find that the loan prices are instead lower for these companies. So this is where we want to ultimately to go. I see that I'm even earlier, Agnese, you will be happier. So let me conclude. So this was really a snapshot of what we are trying to do. So the main result so far is that the common ownership between banks and fossil fuel is typically lower, and is even lower after there are policies up there that become more stringent, being Paris or being the Environmental Policy Index. But this result is driven on extensive margin, mostly. That is, if there are no ties even after. But on the intensive margin, we see instead that if there were ties before, these ties become stronger. And these are the ties that possibly lead the decline in loan prices after the Paris Agreement relative to before. So of course, as I said, this is super preliminary. So let me just give an idea of what we want to bring this further. So of course, we want to use the Environmental Policy Index also for the syndicated loan analysis. We would like to, as usual in corporate finance / financial intermediation, we want to come up with more exogeneity issues. So we want to instrumentalize the Environmental Policy Index in some form. We want to reflect on the use of other common ownership measures. As I said, at the moment, we are just following the literature, and we look at common ownership as the sum of shares in banks or in firms. And the only, if you want, measure that put the two sides together is the number of investors, but I think we would like to come up more with a sort of more synthetic measure that takes both sides into account. And of course, we need to understand better the mechanism. It's not enough to say that they have common shareholders and therefore loan prices may be changing. We would like to understand, but I'm sure Eleonora will come with a suggestion in that respect, which would be most welcome. But this is where we are, and let me say again, we thought this was an interest in itself just to document this time series, if you want, of common ownership, and in particular to see that our desire of seeing more distance between the financial industry and the fossil fuel firms maybe is not there. Maybe these ties, in particular in cases where there were already these ties before, actually strengthen rather than weaken. And let me stop here. And I forgot to say, this is a joint work with Anja Đuranović, who is a PhD student in Utrecht, Irene Monasterolo, and Stephen Ongena. Thank you.
Thank you very much, also for finishing on time.
I gave you some freedom.
So, Eleonora, you can get this 3 minutes extra for your discussion. So
thank you very much.
You have 10 plus 3.
All right. Well, first of all, I want to start by thanking the organizers for having me here. I really appreciate the invite. And introducing myself. So my name is Eleonora Sfrappini, and I'm at the University of St. Andrews. And although I have 3 extra minutes, in the interest of time, let me just start. All right, so what I want to start with is by trying to reframing or remotivate the paper from the literature that I'm most familiar with, right? So this paper is really about lending, it's about transition risks, and it's about common ownership. And if we at least stick with the first 2 of these 3, there is already a lot of literature out there. So there's papers that point to the fact that banks adjust their pricing, they change their credit allocation, they change their securitization choices based on changes in transition risks. And also there's a lot of papers that point to the fact that different banks do this differently, right? So for example, here systemic importance matters for banks' adjustment, but so does portfolio exposure. Green lenders lend differently to green firms. The geographic location of the banks matters, at least insofar as the regulatory stringency of the environment in which they operate, but also maybe or may not banking climate commitments matter. Here, the literature is a bit split. So given this context, it's not too crazy to ask the next question, which is, well, does common ownership matter too? And this is exactly what Elena and her co-authors are doing, right? If we have a borrower and a lender which share common owners, does this lead to a differential adjustment in lending when there is a shock to transition risks? And this is essentially where this paper is going. And Elena already presented her first results, but let me go through them again relatively quickly. So in the first part of the paper, they really focus on whether there is an effect of a change in transition risks on these common ownership relationships. And what they find is that common ownership between banks and fossil fuel firms increases less after a spike in transition risks relative to the common ownership between banks and other firms. They also find that common ownership grows faster between banks and fossil fuel firms, but new relationships are less likely. And in the second part of the paper, they move on and they say, okay, there is this common ownership relationships, right? So now, what happens if there is a shock to transition risks? Does this lead to differential changes in lending? And the early results point to, yes, this is indeed the case. And in particular, if we look at fossil fuel firms, they seem to be getting a preferential treatment, so relatively lower spreads from banks with which they have a common ownership relationship with after an increase in transition risks. So what I want to do with this paper, since it's so much at the early stages, is try to take the next step for the authors and try to think about what are potential mechanisms that might explain the results that they're seeing. And in particular, if we take a look at the first part of the paper, I think one potential story that might fit what they see in the data is the idea that when there is a spike in transition risks, you're going to have institutional investor perhaps shifting more towards less exposed assets. And here, what's important to keep in mind is that banks themselves are less exposed assets, right? The finance sector is a low carbon sector. So after Paris, then it's not too surprising to see that investors are more likely to invest in banks and other firms. If you have an investor invested in fossil fuel firms, then it might diversify at a higher rate. And new bank and other firm relationships are more likely to pop up vis-a-vis relationships between banks and fossil fuel firms. All right, so this might or might not be the mechanism here, but I think it more or less fits what you're seeing in the data. But even if this is the story, right, I think the interesting point that you also made in the presentation is that this common ownership is increasing in time, right? So where the paper really gets interesting, I think, is this next step that you're trying to take, which is, okay, what is the effect of common ownership on lending? And what you're finding right now is this lower spread after Paris. And if we start to think about what is the potential effect of common ownership in this context, the first thing that comes to my mind, at least, is that if you have a lender and a borrower sharing common owners, then the lender here is going to face lower agency frictions, lower information asymmetry, and at this point, if you have a shock like Paris, which raises transition risks for fossil fuel firms, and we know from the literature that this means that lenders are pricing higher the loans to fossil fuel firms, then if you're a fossil fuel firm with a relationship, a common ownership relationship with a bank, you're going to go to that bank because that bank is going to give you relatively lower costs because of these lower agency frictions and information asymmetry. So common ownership here can mitigate this effect. And in a way, this would not necessarily be a negative, such a bad thing. It could almost be a brighter side of common ownership in this context. But we might come up with an alternative explanation for what we're seeing, which is the idea of perhaps investor pressure. So here you could have either directly or indirectly banks being pressured to protect the other investments of their common owners, right? This would not be such a different story relative to the incentives which come with portfolio exposure or asset overhang and the whole zombie lending type of literature. And this might be instead a darker side of common ownership. And we could test this, or I mean, you, Elena, and your co-authors could test this. You could perhaps look at the performance of these loans, and I know this is difficult with DealScan. So alternatively, what you could do is look at the performance of the borrowers exposed, because if it is lower, then this might be more of a story of investor pressure. And then once you get there, I think there's so much else that you can look at. One thing would be relationship development, right? If you do indeed have a new link, a common ownership link, does this mean that a new loan is more likely? What about different heterogeneity in investors, right? If you do have sustainable investors, is there a differential effect here on lending? What about linearity? I know you said you looked at different thresholds, but at what point does it really start to matter? And the last thing that I want to do here in the presentation is ask one final question, Ria. Is this really a story about fossil fuel firms, or is it maybe a story about the other firms that you're talking about, those greener firms? Because when I made the point about the first part of the results, I really said that, well, it could be that investors are shifting towards these other firms, which might explain what's going on. But I could make a similar argument when it comes to the second part of the results, right? Because if we think that after Paris, these other firms, the greener firms, are now having better opportunities, that might lead to an increase in demand for credit for these firms. And if these firms were already getting lower spreads from their common owners, relationship banks, then at that point it might make sense that they demand more from them, which is driving relatively higher prices. This would still be a common ownership effect story. This would still be a story about common ownership, transition risks, and lending, but it would be a slightly different story. So let me just conclude, also on time for Agnese. And what I want to say is that I really like where this is going. This is an interesting direction to take. Is there still a lot to do? Sure. I'm not claiming that this is perfect yet, but I really like the direction. So I'm looking forward to reading a draft of this paper when there is one. And I will leave all the other smaller points and more boring points about specification and samples for you to read later.
Thank you, Eleonora. Elena, would you like to respond?
Yes. So first of all, thank you very much. This is super useful for us. I think I like a lot, first of all, it's typical, in particular in early work, that the discussant is much clearer than the presenter. So thank you for rephrasing the story the way you did. But I like the way you have phrased the potential mechanism behind. I have to say, I tend to think that what's driving it is more that once a shareholder has an investment in fossil fuel, is a sort of sunk, and therefore tries to make this more profitable for the shareholders. Otherwise, it would be, now there is Paris, or there is anyway a more stringent policy, and this investment loses value. So the way to preserve the value of this investment, eventually from the perspective of the shareholder, because we are used to think about bank perspective, but this is really the shareholder that is influencing, assuming that there is this influence. So in a way, the shareholder, instead of risking to lose the value of the investment in the fossil fuel, tries to make it more profitable still by starting investing in the banking sector more and trying to affect the way the lending goes through, in particular on the pricing issue. So, and coming to the second hypothesis you sort of put forward, which is maybe is the more the demand of the other firms. It could be, but then it wouldn't be consistent with the first part of the paper. So if you put the first and the second, I would tend to think that is more, if you want more the zombie lending story, that once, but from the shareholder perspective, not the banks, so that if you have this investment, either you sell it, but you may make losses, or you try to preserve as much as you can. And the way you do it is by investing more in banks and potentially influencing the lending. But this is all to be tested more, but thank you for phrasing the way you did and for the suggestion, very useful.
Thank you. So we have time for opening up to the floor.
Oh, well.
Very interesting stuff. I wonder whether you can do better than just having pre versus post Paris, since you're looking at the US and there has been big changes in attitudes towards Paris over time. I know you have this other index, but perhaps you could look at this more explicitly. And also, could you look more at explore heterogeneity across banks? So banks that have greater European shareholding versus US shareholding, where the attitudes to Paris are different. Thank you.
Very interesting project, Elena. I have two comments or suggestions. So the first, I was wondering whether you can get information on the type of investment that these brown firms are undertaking. Because suppose that the brown firms are trying to become less brown. In principle, then, I mean, banks may want to lower interest rates because these investments are making the banks safer. And in addition, from a social planner perspective, this can be good because we would like to have lower cost of capital precisely for the firms that are undertaking investments for the green transition. The other thing is on the measure of common ownership. Maybe you could explore with the shared board members, so interlocking directors. This is a slightly different concept, but this can be like a symptom of common ownership. And can be synthetic, no?
There are a couple more questions on this side. And
yeah, okay.
Do you want to respond first and then?
Yeah, maybe I just, before I forget. So yes, Beata, we can exploit it more. I mean, this environmental policy index go closer to this change in attitude, but we can try more, in particular because we're looking at the US indeed. Shareholders, absolutely. You say US versus Europe, because indeed we have, for example, Deutsche Bank that could be very active in the US, but of course a much more European banks as charter at least. But what we also thought of doing was to look more at the heterogeneity of the shareholders, if they are active, if they are passive, if they are short-term investors, if they are long-term investors, and stuff like that. So definitely yes. I think, Enrico, you raise an interesting point on the transition of this fossil fuel. I mean, from the bank perspective, I think we shouldn't underestimate the difficulty that banks may have in financing the transition of fossil fuel firms. Because yes, they may, and ultimately they do better. I mean, they improve transition risk, and they make these firms more green. But in financing these firms, they are still subject to all sorts of reputational risk, NGOs consideration, and everything, which may not see the same way. So while I take your comment, it's very difficult for banks to actually finance this transition to fossil fuel industry. But these are interesting suggestions, also the interlocking.
I saw two more hands on this side, and there was a question on this side as well, so you can take three more.
Hello, thank you. I'm Philippine Courtiman, ECB. Very interesting results, and I would like to look at the intensive margin for firms when you have common ownership. There might be one explanation which I think is not explored, which is the price of oil for these production firms, right? We are here in the US, which is a producer of this fossil fuel energy. And typically, the fossil fuel firms will earn more, be more profitable when the oil price increase, and the others, it's the contrary. And the Paris Agreement took place at the end of 2015, entered into force a year after, at the end of 2016. That was at a time where the oil price had plunged. But afterwards it recovered, so maybe it could explain part of why you have more lending and lower prices to these less risky firms in the end, which are the fossil fuel firms in the US.
Let's collect the other question. There was Angela.
Hi, Angela Maddaloni from the ECB. I have a question. Since you're looking at like firms that are listed, if you have look at credit rating of these firms, this is also related to the question of Enrico, because credit ratings, if you believe that they should also incorporate some transition risk, they should maybe also incorporate the fact that firms are going from brown to green or something like this. And credit rating are also very important for investment in general. So institutional investor would decide portfolio allocation depending on credit rating. So this could be also a way why some of the mechanism could be explained.
Yes.
Last question, 1 second, because there was a last question.
But I would say thanks for both of these comments. For the oil price, we already thought of incorporating into the analysis, so we will certainly do it.
Okay. Hi, Beatriz González from Banco de España. I wanted to ask you whether maybe to dig deeper into this investor pressure mechanism that Eleonora was saying, you could think of majority ownership and which whether they have shared majority ownership, so that this can really push for changes in the behavior of these banks. And this, if you find this is stronger for this bank and firm that have this majority ownership that is shared, then this can be an indicative of this zombie mechanism that you were thinking of. Thank you.